So today's Cardinal lesson, we're talking about step up in basis and really why you need to understand this if you own some real estate, some stock, and we're doing your retirement planning, your estate planning, and how there's a tax advantage to holding assets until you pass away. And the people that you leave them to are going to get out of a lot of capital gains taxes. So that's the topic of the video. I want to pass it to Tom, and I want Tom to share with really why are we doing this video today.
Yeah, I mean, we're doing this video because mistakes are costly. And when you start giving things away or start doing things and you don't know what the impact that has, is we see all sorts of problems that arise here. And people end up paying a lot in taxes that they could have avoided. And so we just want to walk you through how this works. What are some ideas? Again, not to say this should be your main focus, but it needs to be a thing to consider. So let me bring up the show notes. You can find these below the link on our video. They're also on our website at cardinalguide.com. We have the board. And then today's show notes really are just more details of what's already on the board. So we don't need to spend a lot of time in the show notes today. But if you watch the video and you want to get a little bit more detail of the examples we're going to use, you can go back to the show notes here and see that. So I'll turn it back to Hans and we'll get going.
Okay, so a step up in basis, that means the basis was here, and the value is here, it's up here, and the person passes away, the basis is now going to become this. So let's go to talk about what we're talking about. Is the first term you need to understand is cost basis. That's an accounting term. And so when you sell a piece of property or you sell some stock, your CPA or your accountant or the person preparing your taxes is going to want to know what's your cost basis. And the cost basis is the amount you paid for a capital asset. So if you bought 100 acres of a field that was used for farming and you paid $2,000 an acre years ago, I mean, that's $200,000 is your cost basis. Now, if you spent money just fixing the fence and tilling the land, or you just did money on upkeep, that doesn't add to your cost basis. But if you built a fence around it, or you were going to turn it into a subdivision and you built roads, those are all improvements. All those add to the cost basis. So the cost basis is what you paid for it, and then the amount that you added to improve it. So, and with a stock, it's just what you paid for it. You'll look into the examples. So that's the first thing you're going to want to know when, for this example, where we're talking about step up in basis. So what is your basis? What is your cost basis? The second thing you're going to want to know is the fair market value, where they're going to tend in the notes to the accountants are going to abbreviate that as FMV. And when you read in the IRS regs of how this is all handled, and the fair market value is the value on the date of death, that the fair market. So if we go back to this land, that we're going to get into some real examples in just a second, but this land that you paid $200,000 for, and then you held it until you died, and somebody then is going to buy it and put a subdivision in there, and they paid you $10,000 an acre or $1 million. And so if you had sold it for $1 million when you were alive, you would have owed capital gains taxes on the difference between the cost basis, 200,000, and what you sold it for, $1 million. 800,000 would be subject to capital gains taxes. If your heirs sold it after you died and it had gotten a step up in basis from 200,000 to $1 million, then your heirs wouldn't pay any capital gains tax if they sold it for what the fair market value was. And so it's a pretty significant thing, but it's not worth running your whole estate planning and your retirement plan around. So I want to just go to Tom for a second before we get into the notes, and I want Tom to comment on that a bit.
Yeah, I mean, I think it's important to understand sort of the general concept here, right? Basis is what you paid for it plus improvements. And then the fair market value is what you sell it for. And generally speaking, the taxes owed is on the difference there. An area that we see sometimes people need to be thoughtful, at least, is when they have rental properties. And so one of the real tax benefits of rental properties is you get to depreciate that property. That's lowering the basis. So it's helpful from a cash flow standpoint. It helps in the taxes as you're earning the rent. But when you go to sell that property, now we have more taxes you'd have to owe. So again, I don't want to. The video isn't on that today, so I don't want to get too down in those weeds. But understanding that concept, basis and value, fair market value, is important because that's again what you're taxed on. And the goal here is to try to minimize that when appropriate. One of the things I just want to caution you a little bit is we have lots of clients that walk through our door and their main focus is avoiding taxes. I don't want to pay any taxes. I'm just going to hold on to it till I die. We see this a lot with individual stocks they earned as if they were working for a company or they bought years ago, and it's had a great appreciation. Right, the value is way more than they ever put into it. But what effectively they've done is they sort of handcuffed themselves where they're not willing to sell any of it. They don't want to pay any taxes, and they have all this money, but they can't access it. Right, and so again, our goal here isn't to say you should never sell it, right? I mean, sometimes it makes sense to sell it. If you want to do something with it, you want to reinvest it somewhere else. It shouldn't be the main focus to always avoid these taxes. But if we're doing things like gifting it to our kids, this money's going to go to them anyways. I'll just give it to them. We want to be maybe more thoughtful of that. And really, where we see the biggest mistakes made is on property. So real estate, generally their primary residence. A lot of times we see this happen as parents are getting older. They start thinking about, potentially needing some type of long-term care. They haven't done any planning up to this point, and they've heard through friends or someone has told them that the state can come take your house, which is really an oversimplification. It's not that simple, but they don't want to lose their house to the state for Medicaid. So what they do is they gift their house to their kids, which can make some sense. Like, oh, we'll get this out of my estate. The state can't access that if I'm trying to qualify for Medicaid. The problem is now we've just removed the step up in basis. Right now, if your kid owns the house and you die, there is no step up upon death because that's not you don't own it anymore. I'm talking to the parent here. And now the kid goes to sell it and they didn't expect this huge tax bill. So it's not always the best planning strategy. Again, I think more thoughtful planning around long-term care is a better route to go. Furthermore, if you're gifting the house, it has to be more than 5 years before qualifying for Medicaid. It's complicated. I don't want to get too far here, but don't just go giving your house away without having thought through the implications of doing that, especially when you're looking at planning for Medicaid.
Okay. So we know what cost basis is, the amount you paid for it. We know what fair market value is what it was worth on a person's death. The purpose of this whole thing is to reduce or eliminate capital gains on inherited assets. So tying in with what Tom said, many times we are looking at all of a person's assets and helping them decide which are we going to sell during your lifetime and just go ahead and pay the tax. And how are we going to sell that? How are we going to spread that tax out so you can have use of the money and enjoyment during your lifetime? And then which assets are we going to consider holding until your death so that the people who inherit this are going to get a full step up in basis of the thing. And that's only going to be beneficial if they then sell it. If they're going to hold them for a long period of time, then so anyhow, in planning, the purpose of this exercise is to learn how to appropriately use this to eliminate capital gains taxes on some inherited assets. I want to point out that there is no step up in basis for money held in an IRA. Okay, the IRS is going to get their tax money out of your IRA, unless it's a Roth, unless you've already paid the taxes. This doesn't apply to IRAs. And then also there's a 1-year look back on reverse gifts. So, what a reverse gift is like if my home was appreciated, like I had a $2 million house or $3 million house, and I had only paid $400,000 for it 25 years ago. And So what I'm going to do is if I sold it, I'm going to owe big capital gains taxes. And my mother, who's still living, I gift my house to her, and then she now owns it at my cost basis. She dies, she gets a step up on basis on my house and gives it back to me. I've now increased the basis on my house. It's a it's a little bit of a kind of slippery strategy, but people use it, and there's a 1 year look back on reverse gifts. So just understand that. And this video is not about how to do reverse gifts, but there are situations where we might recommend one of those to a specific person, but then there's risks with that because things may not happen like you think they're going to happen. So that's what I want to do is hit on some of the examples here to really show you how this works. So we take 1,000 shares of stock that you bought at $10 a share years ago, and so you have a $10,000 cost basis. We sell, excuse me, when we pass away, we hold these till we die. And when we pass away, the stock's worth $100 a share. So it has a $100,000 fair market value. If we sold them before our death for $100,000, we'd subtract the $10,000 cost basis, and $90,000 would be taxable at these capital gains tax rates. If we held it until our death and willed it to our heirs, and they sold it quickly after our death, they would have zero tax. So that's a pretty simple example. I want to go over a couple more examples. The California principal residence. This is an example of somebody that we ran into, and this is fairly common in California. This couple had paid $260,000 for this property, way back whenever that was. And when he's selling it, when we ran into him, he's getting $1.6 million in the current days. And his wife passed away in 2018. And he wasn't really aware of that she got a step up in basis. So their cost basis went from $260,000. And because they're in California in a community property state, the fair market value in 2018, which we were able to establish really going to Zillow and a couple of other sites, and establishing what the value of the house was when she died, it was $1.1 million. And he got the whole step up in basis because California is a community property state. So you say, what? And so these are the community property states. California is one of them. That you get this benefit if one spouse dies on capital assets. In a community property states, the stuff is not divided 50-50. It's like it's the whole, and you together own it. So when there's a death and with the capital assets in a community property state, it's kind of interesting. It's a federal tax, but it's governed by state law. He got a step up in basis to 1.1 million in 2018, but then he sold the house in 2024 for 1.6 million. So then he was able to use a $250,000 single family residence, lived in the house the last 5 years. So he only had to pay taxes on $250,000. And so he was quite happy about that. Now, another example we're going to give is in a non-community property state, which is South Carolina. And this was not a principal residence. This was a vacation condo down on Hilton Head. And these people, the cost basis was $110,000 that they paid for this thing way back when. He died in 2022. The husband died. I mean, all of these people come to us after the death, and then they learn about this step up in basis. And it was a little more complicated with them because the fair market value on his death was $500,000. And the husband's half got a step up to half of the 500,000 or 250,000. The wife's half still was half of the 110,000. So the new cost basis in 2022 is 305,000. They sold it in 2024 for 550,000 minus the cost basis of 305,000, and she had to pay tax on 245,000. But this was very pleasing to her because she thought she was going to owe tax on all the amount over 110. So we were able to help her get through all of this and got her to the right tax advisor that did her taxes, and she was quite happy. So, I mean, those are the examples that we have, and we want you to understand this now so that you can take advantage of this in your estate planning. I mean, people that come into us, we do estate planning for all our retirement plans, and we got a section on that. And it may well be that you don't really want to be burdened with worrying about capitalizing on the step up in basis. You may want us to figure out a way for you to use your assets without them running out. And so this is a question of priorities, but this is an essential piece of your learning. If you own some capital assets, you own some stock outside of an IRA, is really to understand this concept so that you can just use it to your benefit. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.